Next fund. Learning Objective 18-3. Make calculations and record journal entries for debt service funds. You know that when an internet joke is being produced by your accounting professor, that it has gone so mainstream that it's lame. Anyway, let's talk about debt service funds. Now, debt service funds are not debt funds because remember, these are governmental funds. They do not have long-term debt, long-term liabilities in them. So the purpose of a debt service fund is not to keep track of how much money you owe. It is to keep track of how much money you have saved to pay your debt. So debt service fund accounts for servicing your debt. The debt itself is you're going to be in your general GCA, GL, TL general ledger. Try remembering that. But the money that you set aside to pay off the debt and the paying off of the debt is handled by the debt service fund. So what do we mean by servicing of debt? We mean paying interest and paying off the principal when it becomes due. And again, the accounting method here is going to be just like the general fund. It's going to be the modified accrual basis, except interest is not accrued until it becomes due, and principal payments are not recorded as liabilities until they become due. So types of debt that we would be looking at would be serial bonds, term bonds, special assessment bonds, notes and warrants, capital leases also are going to be managed through a debt service fund, and there'll be the actual amounts that are owed are going to be kept track of in this A, B, C, D, E, F, G, H, I, J, K general ledger thing over here. So what are these different things? I hope I'm probably just going over something that you know, but it's worth it. Serial bonds involve installments. Term bonds is where the entire principal is due on one date. Special assessment bonds are secured by certain tax liens. So what you may have is you have an area, you have a district that needs something. Let's say they need new roads or new sewers. So what you do is you're going to charge them a tax to pay for the sewers, and you're going to borrow money to pay for the sewers now, and then you're going to use that tax over the coming years to pay off the sewers. So a special assessment bond is used to finance a capital project, and the special assessment means there's going to be an additional tax lien to cover the cost of that project. So the special assessment itself is the bond holders have a right to that special assessment because they funded the project. So a special assessment would be made on taxpayers. I like the term against taxpayers. They're made against taxpayers because taxes are always assessed against us. But they're designed to provide an improvement to them. So it could be used to pay for sidewalks, street lighting, gutters, I don't know, I guess gutters are streets, sewers, various different projects that are going to directly benefit them. And then the special assessment bond is used to pay for the improvement, and we charge the taxpayers the special assessment, and the money that comes in is used to pay off the bond. And the construction activity will be in the capital projects fund, and the accumulation of the tax is going to go into a debt service fund. You'll see that in a moment. So within a debt service fund, a government can have various different kinds of fund, long-term obligations, other ones, we went through a few before, notes and warrants and capital leases. So what we do is we accumulate funds in the debt service fund, and the purpose of this debt service fund is to pay off the upcoming principal and interest payments. And this is based on modified accrual. So your function here is to accumulate resources to pay off debt, principal, and interest as they become due. I've only said that like 8 or 9 times. I'm really sorry. I'm trying to use the PowerPoint slides, and sometimes they're just very repetitive, and I guess that's not very pleasant. And only the long-term debt that is mature and payable now is going to be recorded. And interest will also be recorded when it becomes due, and rather than being accrued over the period of time that it's relevant to. So we're going to start off with a debt service fund budget. Let's look at the scenario here. The scenario is that 10 years have passed since I last did these notes, but they get better every time. Solid City establishes debt service fund for $100,000, 5-year life, interest 10%, annual payments $20,000 a year, and it's due 2022. In fact, this might look very familiar to you because this is the debt from the capital project on the courthouse that we were just doing before. Remember where we got 102 instead of 100? So we have a budget to pay the principal, $20,000 this year, and also to pay $10,000 interest. That's $100,000 times 10%. And we got an extra $2,000 from the capital project fund, which is good news. So my budget is going to look like this. I'm going to debit estimated revenues control. And remember that budgetary entries in governmental accounting are in reverse. So estimated revenues are going to be debited and appropriations are going to be credited. And I've also got estimated other funding sources transfer in. That's going to be the $2,000 coming from the capital project fund. And I've also got the difference is going to go to a budgetary fund balance. And you can have a budgetary fund balance in a debt service fund. That'll be $2,000. So let's record revenue from a specified property tax levy. And we're going to have a property tax levy that's specifically purposed towards this capital. I don't know. I guess we're going to tax the criminals. What does that have to do with the courthouse? I don't know. Anyway, let's just go along with the problem. The book made it up. They know more than I do. We receive the premium from $2,000. Then we're going to have this property tax levy. We're going to have some uncollectibles. And this is really the same as the general fund. So let's first take this $2,000. I'm going to debit cash for $2,000. And I'm going to credit other financing transfer in from the capital project fund, $2,000. And then I'm going to book this property tax levy just like I would in a general fund. So I'm going to debit property taxes receivable for the total amount, and that's going to be $35,000. I'm going to credit, and this is a little different, remember, from how we do this in commercial accounting. We're going to credit the allowance for $5,000, and then the difference of $30,000 is going to be credited to revenue property tax. And again, the strange thing here is that property taxes revenue is recorded net, whereas for companies it's going to be recorded gross, and then when I estimate the allowance, I'm going to record a bad debt expense. Here, the bad debt expense just offsets the revenue, and it's not recorded as a separate expense. So record property tax levy, and then I'm going to receive $30,000, debit cash, credit property tax is receivable. What I like about this, honestly, is that it gives you a review of the previous chapter. So it's nice to see this again and just see, also see that it has changed since the last chapter, but it helps you remember it to see it all again because it's exactly the same. And now I got to do this thing with the delinquent property taxes. So what I'm going to do is I'm going to reverse the current accounts. And I have this property taxes receivable of $35,000 set up. It's 35 minus the 5,000 that I actually, minus the 30,000 that I actually collected, and I'm going to debit property taxes receivable delinquent. I hope this looks familiar. 5,000. Then I've got to switch my allowance also, allowance from uncollectible, I don't know, it should say for uncollectible accounts. I'm doing a lot of typing. So I have an allowance for uncollectible accounts of 5,000, and I'm going to credit allowance for uncollectible taxes. Oops, it should have said taxes. Delinquent. $5,000. And that is going to move receivables and allowance to delinquent. Next, let's expend some money. So I'm going to make principal payments of 20,000 and interest payments of 10,000. This is going to be an expenditure because we never had these debts in this general ledger, in this fund in the first place. So when we spend money, it's just an expenditure like everything else, which should really seem strange to you after all the financial accounting that you've been doing. So we debit expenditures now and we create the payable. And then we're going to pay off this payable. And the reason why it now becomes an expenditure is because the payable now becomes due. I often wonder, like, if government was forced to use regular financial accounting, if it would be more efficient. Because you're really, like, encouraging, by doing it this way, governments, in a way, ignore their debt until it becomes due. And here you see it also for interest. It's going to be the same thing. I'm going to debit expenditures for interest. The truth is that you really spent the money a long time ago. What did you spend it on? You spent it on that courthouse. But the book, neither the asset nor the liabilities went into any funds at the time. It just goes into that account group, that A, B, C, D, E, F, G, general ledger, whatever. So recognize liability for matured interest. And then I'm going to pay it off. So debit matured bonds payable, debit matured interest payable, and the amounts are going to be matured bond payable would be 20,000, matured interest payable is going to be 10,000, and credit cash for $30,000. And then we got to do our closing entries. So the first thing I'm going to do is I'm going to close this budgetary entry. While you weren't watching, I split my screen. So you have here the budgetary entry on top, and you're going to have your closing entries down here. So I'm going to debit appropriations control for 20,000, debit budgetary fund balance for 2,000. I'm going to credit estimated revenues control for 20,000, and I'm going to credit estimated other financing uses transfer in, I'm spelling it all out for you, $2,000. And that's going to reverse budgetary entry. Next, I'm going to close all my temporary accounts. Let me make this a little larger here. So let's go through the various temporary accounts that we have here. We have revenue property taxes. And that was $30,000. I've got expenditures principal. That was down here of 20,000. I've got expenditures interest of 10,000. And then the difference between these is going to go to fund balance assigned for debt service. Wait, I missed something here. Here I missed a piece. Because remember, we had year-end estimate of collectibles of $2,000, and I still had $5,000 in my delinquent here. So there was a little mistake in how I did this. Let's fix it. The allowance for uncollectible delinquent should be $2,000. And then I've got to credit the difference of $3,000 here would be credited to revenue property tax, because that is any excess bad debts. We expect to collect $3,000 more, right? So if we expect to collect $3,000 more, then revenue from property taxes is going to be $3,000 higher. And that's different. In financial accounting, it would be adjusted to bad debts. So that also affects, that's why I saw this mistake here, because revenue for property taxes should be $3,000 higher. So this should be $33,000, and then the difference between these, 33 minus 20 minus 10, is going to be equal to fund balance assigned for debt service. And then we've got other financing, we got an other financing source here, right? This $2,000, so we got to close that also. That's the only, I don't have any other financing uses, just other financing sources. So transfer in from CPF, you can see this at the top of the screen. I'm going to now debit that for $2,000. And the credit again would go to fund balance assigned for debt service, $2,000. And so we should have a little bit of money left here for debt service. Let's talk briefly about this A, B, C, D, E, F, G, H, I, J general ledger. So this is going to be used to account for these capital assets and for long-term debt. And you would only use it to account for the assets and debt that isn't in some of the other funds, the enterprise funds or the trust and agency funds that will account for them. So everything's got to go someplace. And if it's not going to go into an enterprise fund or an agency fund, then it's going to go into this general ledger. It's not a fund, it doesn't have cash, it doesn't have a fund balance, and it should self-balance. So classes of capital assets that could go in here are like so. And whenever you have infrastructure, things like streets and roads that the government pays for, then these should be accounted for in this general ledger. And they have, the definition is that they are stationary in nature, and infrastructure assets are usually preserved longer than other types of capital assets. So these are depreciated, except for certain infrastructure. And you don't record the depreciation in any government funds, but the depreciation will be recorded in the government-wide financial statements. If you sell these assets, they're going to be recorded as other financing sources in the general fund, which will receive the money. So some of the debt that you would record in this general ledger would be general obligation bonds, claims and budgets, compensated absences, because those do have a long-term nature to them, unfunded pension contributions, capital leases payable, and special assessment debt with some government commitment attached to it. And if you pay off the debt, then the liability gets moved over to the debt service fund where it can be paid off. What's called non-debt issuance liabilities, and it's a lot to explain exactly what that is, but those would be transferred to the general fund. And again, these liabilities are removed at the maturity date, just to emphasize, they're not removed at the when they become current. One more item is that debt service funds can invest money, so they don't just have to have cash, and these investments will be reported as an asset. And usually they're going to invest in very secure investments like Treasury securities, CDs. I think they may also sometimes invest in state and local government bonds that are federally insured. And interest on them will be accrued as it's earned, which is a little weird, in accordance with GASB 31. I say that it's weird because interest expense is accrued when it becomes due.